Mark Valek and Ronald Stoferte have just released their excellent In Gold We Trust report, and today we take a look at some of the major takeaways for gold in the coming decade. So let's dive on in. Now, this channel provides global macro insights for informed investing, so do consider subscribing. Now, the report with the link in the description highlights a number of key points relating to the short-term and the longer-term outlook for gold, which include each of these key points we can see here. So firstly, let's start by actually investigating the fact that the Fed's monetary policy normalization failed and seemingly helped to actually lead to and generate the liquidity problems we saw in September 2019 with the repo market. Here we can see the attempt to reduce the size of the balance sheet, a situation Jim Rickard's likened to that of Odysseus trying to sail his crew home between the narrow channel of Scylla and Charybdis. Scylla, a six-headed monster who represents a drawn-out economic decline, and Charybdis, a dangerous vortex reflecting an economic depression. But by the end of 2019, as the authors are keen to point out, Japan, Italy and Germany were already in the midst of or about to re-enter recessions. While global trade normally grows at double that of GDP, it actually was in negative figures at minus 0.5%. Now, previously, the authors had given gold price forecasts for the period of Trump's first term in office. In this table, we can see the four different scenarios. While the authors argue that the world's largest economy has largely muddled through, we're clearly well into scenario D now, where they identify potential price outcomes of somewhere between $1,800 and $5,000 per ounce. Secondly, the authors acknowledge that the ongoing health crisis is the accelerant to a long overdue recession. This has then reinforced negative long-term implications for the economic outlook, as we have seen a complete U-turn in the Fed's monetary policy and a crescendo of fiscal policy announcements come from the governments. Meanwhile, an already poor economic outlook deteriorated rapidly. The longer-term implications of such policy decisions are obviously profound and lead us on to our third point. And that is, of course, that the debt-bearing capacity of our economies was already at crisis levels in terms of sustainability. This was true of households, of firms, emerging markets, and also industrialized nations. Now the size of fiscal deficits and national debts is so enormous that significant inflation will need to be generated to help reduce the real size of these debts. Thus, the authors argue that there may be a need to rebalance the inflation targets used by central banks. The historical data provided in this chart looks at inflation and deflation from the period prior to the inception of the Federal Reserve, where people's money increased in purchasing power in 43% of the years. Then the period after the Bretton Woods Agreement, where deflation occurred in 19% of all years. Finally, post-1971 and the removal of the gold standard, which has helped to actually ensure, on the behalf of central banks, continual reduction in our purchasing power of the people's money. And of course, deflation must be avoided for a number of key reasons that include, firstly, that deleveraging debts leads to consumer price and asset price deflation, which gives rise to declining tax revenues. Meanwhile, deflation won't merit the pay rises which facilitate fiscal drag. That is where people's incomes increase and they get pulled into higher tax bands. Falling prices leads to an increase in the real size of debts as well, on behalf of debts of households, firms and our government. This would generate increased bankruptcies among households and firms and governments, of course. The third impact would be to devastate the banking system, which benefits from the Ponzi scheme of ever greater currency debasement. And our central bank's mandate of price stability gives them the ability to ensure they attain such 2% targets, yet the authors use the traditional definition of inflation as the expansion of currency and credit giving rise to higher prices. Their historic analysis identifies that central bank finance debt has always led to rising inflation rates, and this seems obvious when you consider that those who may be in receipt of stimulus checks, helicopter money or MMT will spend almost all of the money they actually receive. In economist jargon, they have a high marginal propensity to consume, which could even be as high as 100%. So they spend 100% of all money they receive. Crucially, debt monetization of this sort boosts money velocity. It does not remain stuck in real estate or financial assets or stuck on balance sheets as we have seen with traditional methods of QE. They identify this as the likely trigger to move from deflation to inflation. And as the famed economist Friedrich Hayek said, fighting depression through forced capital expansion is like trying to heal an evil by its own causes. The authors argue that true safe haven assets will remain scarce, and they are extremely bullish on the outlook for gold, silver, mining stocks, and also cryptocurrencies. Fourth, that central banks would be left in a quandary in being able to actually tackle future inflation due to the excessive over-indebtedness that they have actually promoted throughout the global economy. The IMF has already said that global public debt will rise from 69.4% to 85.3% by the end of 2020. Increasing the interest rates, the cost of borrowing with such high levels of indebtedness would cripple the global economy once again. Accordingly, the authors investigate the policies of financial repression, which will be used to rebalance the public's wealth back towards the government to restore some sort of normality to the public purse. Inevitably, this will need to take place through currency debasement, inflation, negative interest rates, and excessive taxation. But all financial crises have their origins in far too expansive monetary policy, fueling a wild party before the Fed's intervention precipitates the crisis they allegedly seek to actually avoid. They believe that the Fed will be left impotent in dealing with the consequences of the enormous fiscal and monetary policy expansion that has taken place. Moreover, other inflationary causes are reflected through potential deglobalization as supply chains move away from certain countries, rising minimum wages, and declines in productivity. In addition, as consumer price expectations rise, this may well enforce a self-fulfilling prophecy, and the authors state that we are concerned that we are witnessing one of the biggest monetary experiments in human history. Fifth, the report investigates alternative investment options by comparing gold to the S&P 500 and using the Dow Gold ratio. They identify the relative undervaluation of gold compared to stocks. Inevitably, this leads them to questioning the potential upside for equities. Furthermore, traditional safe haven assets, such as US Treasuries, they outline as having far diminished appeal for the following reasons. Firstly, that they offer poor and even the possibility of negative yields. There's the risk of currency devaluations, while at the same time the sheer level of deficit spending means that increasing numbers of bonds are actually being issued. Thus, they are not a true scarce asset class. As fund manager Louis Vincent Gave has said, if gold is just a pet rock, a bond that pays no yield is just pet paper. Additionally, while they broadly agree with Brent Johnson's dollar milkshake theory, they note that Trump is keen to see a more competitive, weaker dollar. Both dollar scenarios are, of course, bullish for gold, and the author's view is that silver will quickly follow, while mining stocks are extremely well placed to benefit. Moreover, they cite commodities more generally as being significantly undervalued, as we can see here with the S&P GSCI WTI commodity index. This consists of the following component commodities and their respective weightings. Sixth, the report cites that we're on the cusp of a new monetary world order. They argue that gold will play an important role as a stateless reserve currency. Indeed, a Deutsche Bank report stated before the outbreak of this crisis, the forces that have held the current fiat system together now look fragile and they could unravel in the 2020s. If so, that will start to lead to a backlash against fiat money, and demand for alternative currencies such as gold or crypto will soar. This chart nicely summarizes the current economic situation by illustrating various market and macro numbers at the all-time high levels for gold in both 1980 and 2011, while comparing these same indicators as of April 2020. Meanwhile, the authors describe the role of cryptocurrencies in educating a younger generation on the concept of sound money. They argue that this will lead to a new generation of those understanding precious metals as long-term stores of value. So overall, the report nicely summarizes each of the key trends we can see highlighted here and correctly identifies how these factors beyond those normally affecting demand and supply are likely to actually set gold up as one of the top assets to own in the 2020s. Now, I've put a link to the report in the description, so do check it out. Now, I'd just like to say thanks so much for watching, and do make sure you hit that subscribe button, hit the like button, and look forward to seeing you next time.